treatment revenues from American clinics showed a 21% increase, whereas total revenues increased 51% during the second quarter. What's your comment on the report figures?
We were very pleased with the results that we posted for Q2. The 21% quarter-over-quarter increase from our U.S. pay-per-treatment business was as we expected and what we forecasted. But in addition to the pay-per-treatment revenue, we were also able to make a number of unit sales via our distributor network around the world. And then finally, in the second quarter, we began to realize revenue from the service and maintenance contracts as well as lease revenue that we assumed from our previous European distributor, Sysmex. That's a really important development for the company in that we now control our both sales and service revenue business from the continent. At the end of Q1, we canceled our distributor arrangement with Sysmex, acquired their install base of 91 units across 11 countries. So now we are able to sell directly into these markets. And previously, that base of units we were responsible for servicing and maintenance when we received no revenue after the initial sale was made. Now from that base of installs, we are able to recognize both lease revenue as well as revenue from service and maintenance agreements, and now again have the ability to sell directly into a very, very large market that will become more of an important source of revenue for this company moving forward.
The operating loss has improved significantly during 2018. Prior to the move of the operational activities from Sweden to the US, you expected cost cuts of around 15 million Swedish crowns annually starting mid-2018. To what extent have you been able to realize these savings?
The transition of operational activities from Lund to the US is complete. It was actually completed in advance of where we expected it to be done. So by end of April, virtually all activities that we anticipated moving to the United States have been done. We still maintain an operation in Lund, however now it's far more efficient and our overall cost profile is dramatically reduced.
The operating loss for the second quarter was 2.7 million Swedish crowns. When is break-even within reach?
Break-even from a continuing operations perspective is very close to being in reach. And we define that as what is the cost to run this company, all of our personnel and operating costs. With a revenue run rate of approximately 9 million crowns, that number is really close to being reached right now. The 2.7 million the loss of 2.7 million this quarter was mostly attributable to the investment we are making in the new device development process. So as far as forecasting when we will actually be break even, if not cash flow positive, we are still hoping for a Q4 2018, Q1 2019 date to actually post an operating profit.
By September, Dignitana has 144 DigniCap units up and running in the US, up 3 units since the first quarter this year. In order to sustain revenue growth in the US, you need to increase the utilization of existing locations. Tell us a bit about this work.
Sure. The net increase of 3 units from first quarter to second quarter also included the loss of 17 devices at one customer in the greater New York area, which we have discussed previously. So net, we installed 20 devices over that quarter. And the fact that, again, we showed a 51% revenue increase, 21% directly in the US, despite having lost 17 devices at the end of Q1, was really an incredible accomplishment for the company. So now with that one large customer loss behind us, we are very focused on adding incremental patients and device counts as quickly as we are capable of doing so to ensure each of those devices do have proper utilization rates. And for us, that involves a significant level of training, retraining, and maintenance for each customer to, again, ensure that our units are efficiently utilized at each site.
Well, what is the competition like in the US?
At this point, we have one competitor. Paxman Coolers from the United Kingdom, also listed here in Sweden, is our only competitor right now from an FDA cleared perspective. They joined the market about a year and a half ago. There is tremendous opportunity for both providers at this point, in that we are barely just scratching the surface of the demand in the US.
You are developing a smaller scalp cooling unit. Can you give us a brief background to this project?
Certainly. The only device we have available today is capable of treating 2 patients. There are a great number of facilities in the United States that offer patients the opportunity to be treated in a single patient environment. And for those facilities, a 2-patient device is overkill. We'll never obtain machine utilization rates capable of justifying the investment in that larger device. Additionally, for a number of very high traffic, dense urban environments, the existing unit is also quite big. So bringing a smaller device to market that has a lower cost of goods sold, as well as being more efficiently utilized, is a really important project for this company.
So this new unit, will it also require FDA approval?
The new device will need be cleared under the FDA's 510K program. So we already have a predicate device in the existing Dignitana C3 device. So what we need prove with the new unit is substantial equivalency. And we're able to do that via engineering reports and bench testing. So we will file the application for an additional 510K for this device in Q4, and we anticipate the FDA deciding on the clearance of that within its standard 90-day time frame.
So when is the new unit launched to the clinics?
We anticipate being able to start providing clinics the new device towards the end of Q1 2019.